Good morning, everybody. I see we've got a couple of people that know our story, so I'll try to move swiftly through it and see if there's any questions at the end. I joined DCM just over 2.5 years ago after 37 years in the consumer goods world, and been off to a reasonably good start over the last couple of years, and we'll talk about our story here. Talk a little bit about what we do here at DCM. Recent acquisition, 5 months ago, we completed a pretty sizable deal buying. You'll hear two different acronyms, okay? You'll hear RRD and you'll hear MCC. So RRD, we bought the Canadian division of R.R. Donnelley Canada, right? Of R.R. Donnelley Global, rather. But it's referred to as MCC, Moore Canada Corp, because R.R. Donnelley years ago bought Moore Canada Corp. So we bought the shares of Moore Canada Corp. And now RRD globally wants us to refer to it as Moore Canada Corp. So you hear me say MCC. Don't want to confuse you. So I'll talk a little bit about that deal, how we're doing in terms of building a bigger and better business with that acquisition, and turn it over for Q&A. So a little bit about what we do, and I'll take it at a really high level and simplify it. We help clients simplify complex marketing, communication, and operational workflow. So we work with large enterprise clients, principally Canadian clients. 400 large enterprise clients represent 92% of our revenue. So the larger the client, the more complexity a client has, the more value we can bring to that client, and it's a beautiful, kind of virtuous model. I'll talk a little bit more detail. Been in Canada for over 60 years. Again, this number's changed slightly. Over 80% of large corporations across Canada we do work for. Do a lot of government work as well. And then we're pretty sizable, kind of number 2 in Canada at just north of $530 million in revenue. So pretty sizable, marketing, communication, and workflow optimization company. We'll get a little more detail on that. Not going to spend a lot of time on this slide, but I'll kind of simplify what we do. On the left side, this kind of think of workflow execution that ends up as a printed product. Some could end up as a digital product as well. So commercial print, business forms, labels, large format print, a lot of kind of in-store, in-branch, in-restaurant activity. Do a lot of fulfillment and a lot of work on the electronics form side. So that's a big part of our business, and I'll show you our footprint in a minute. We enable all that workflow with technology. I'll talk a little bit more detail there. And then we also have a marketing services team as well. So if you're a large retailer or a large branch or a large bank, and you need full kind of marketing services from concept through to execution, we do that entire workflow. We like to say the more complex a client, the more value we bring, the more margin we generate. So we like that highly complex area of marketing communications. So I want you to understand and we'll talk a little bit in a minute. The print market or the communication market in Canada is a sizable market, but not all profit pools are treated equal. And I'll give you a little bit of detail on that in a minute. So again, the larger the client, the more complexity that client has in their marketing workflow is an ideal client for us, right? A large client with simple workflow, not an ideal client. Large client that's super complex, ideal client. A good example of some of the clients we work with, obviously many more than this. 8 key verticals. As I said, 400 clients represent 92% of revenue. And you can see some of the clients on the list here. Our largest vertical would be in the FI space, the financial space. And you can see we're working with pretty much all the major banks across Canada. So many different things we do for each one of these banks. I'll give you an example. I won't talk the client, but a financial institution may have branches, 1,000, 1,200 branches. Anything you see in that branch, we would manage that workflow for, whether it's on the window, on the wall, on the floor, at the counter, behind the counter. We would manage that entire kind of ecosystem. Same branch may have a credit card group, and they're doing personalized direct mail. Think of pre-authorized approvals for a new credit card. So that's what we call, personalized direct mail. We would handle all that for them. Private wealth, they may have private wealth advisors that are doing regular communication to their clients and prospecting new clients that they need to simplify that workflow and automate that workflow. We would do that for them. So many examples within kind of one bank where we do multiple things. And that's an example of a lot of complexity, and we kind of solve that communication complexity. We've got national reach and capabilities. Going to talk about that in a little bit more detail when we talk about consolidation. And then we use technology to support a lot of that workflow. If you look at this platform here called DCM Flex, that's what we call our workflow optimization platform. So that example of a large bank that needs collateral or needs material to 1,200 branches, we need to automate that workflow so the branch administrator can order online. And obviously we kit and collate and deliver as an example. Many examples obviously in healthcare and QSR and retail where we automate that workflow using technology. We're just getting into the digital asset management space. Don't have enough time to talk to you about that today. We're also in personal video space as well. So think of that example I just gave you of personalized communication for a pre-authorized credit card. We now have the ability to do that in video at scale. So instead of opening up an envelope at home, you open up a video online or through your email, and it tells you, hey, Richard, you're pre-authorized for this $30,000 or $30,000 for this new whatever card from this bank. So we have the opportunity to do that at scale, and we've been pretty active with clients there. Okay? And then OptiChannel is a platform that allows us to understand the physical attributes of every single branch or every single retail outlet or every single QSR, and then optimize the workflow to that branch, to that restaurant, or to that retail channel. Talk about quickly the industry. The Canadian market for marketing advertising services is pretty sizable, $68 billion. By the way, 96% of our revenues are Canadian-based revenues. We love the Canadian marketplace. For marketing and print media, it's north of $22 billion. And for commercial printing, if we kind of zoom into that, it's around a $10 billion market, depending on what data you look at, flat to growing at 2 to 3%. But not every margin pool or every profit pool in the commercial print area is treated equal. Again, the more complexity, the more value, and generally the more growth. So think of that example I gave you for direct mail. I don't know about you guys, but I collect all the direct mail that I get, the personalized direct mail I get at my house, and I bring it to the office. And we share what we're doing and what we're not doing because we want to obviously prospect the direct mail that I get that we're not doing. But there's a massive amount of direct mail if you start collecting it. And a lot of companies that moved their personalized direct mail to digital personalized are now starting to move back to either both or back to print because print converts at a higher level than a digital product, right? And it's all about conversion. It's all about driving penetration and conversion. So big market, not every profit pool in commercial print is treated equal. We play to the highly complex and hence higher margin areas of the printing industry. I want to talk a little bit about the acquisition of Moore Canada Corp. As I said, RRD Canada. We closed April 24th, so we're almost exactly 6 months in. It'll be 6 months at the end of the month. Our total purchase price was $135.8 million. That was after all the working capital adjustments. Here's how I want you to think about it. We paid $100 million for the business, which is about 4.5 times EBITDA, and we paid $30 million, put the working capital adjustments aside, we paid $30 million for the real estate. So there are 3 pieces of real estate that came with this acquisition. We've already sold one, and you'll see that, $23 million in proceeds. We've got 2 that we're in the process of selling right now, so we'll net north of 30, which is a great deal. So 4.5 times for the business, which is a great price for a business like this. We financed it, 100% financed by Fiera and by Bank of Montreal. We did a capital raise in May 25th. We put those proceeds obviously into the debt. And then we did one of the properties, as I already said, was sold and leased back. And then we've obviously got strong free cash flow. I'll show you where we are in debt right now. The acquisition made a lot of sense for us. We actually bought out our biggest competitor. So a lot of opportunities for consolidation in the marketplace. It allowed us to expand our product offering, improve our service levels. We bought some new execution capabilities. a very good company, part of a large kind of multinational, and expanded our client base. As I said, pre-acquisition, 250 clients represented 93% of revenue. We picked up another 150 enterprise clients, so we're now at 400 enterprise clients. Some incredibly highly skilled people and some great innovative product as well. This just looks at our kind of pre and post acquisition. You can see that revenue on the dark blue bar for DCM legacy, $275 million in revenue. You can see that DCM legacy business, we have been very growth obsessed over the last couple of years. We grew organically 16% last year in 2022. We obviously add 256 on the top. That puts us up to $530 million in pro forma revenue. Gross profits, for those that pay close attention to this chart, you can see that the gross profit for legacy DCM was considerably higher as a percent of revenue than legacy MCC. That's another attractive thing in this deal. We have legacy DCM 30% margin, MCC 20% margin, and we apply the playbook to take that 20 to 30. So lots of opportunities for value creation there. And you can see the adjusted EBITDA number at 64.6. We were very well prepared. As I said, we're almost 6 months in for integration on day one. We worked with Boston Consulting Group, who I had done a lot of work with in prior deals to help us on pre-merger integration. We identified between $25 and $30 million in synergies before day one, across these 4 areas. I can happily say we're at the high end of that target right now, and possibly even more. Operational efficiencies or operational synergies, we've already announced the closure of 4 facilities. So that map I showed you had 14 facilities. We'll have 10 by the time we complete those organizational integrations, or operational integrations rather. Organization, that's about optimizing our SG&A, so all of our support functions. Procurement, that's about finding opportunities where we had the best price between suppliers and also leveraging scale. We're already happy to report that we're kind of north of $5 million on procurement synergies annualized. So we're off to a great start there. And revenue, we were actually very conservative from a revenue synergy forecast, as you'll see in a minute. But we're off to a very good start in terms of growing revenue. We call it expansion revenues with existing clients and new business development, now that we're a bigger player in the marketplace. So great progress on our synergies. We've been obviously relentlessly focused on this for the last 5 or 6 months, but we're off to an incredible start. We were well prepared going into it. A little bit about momentum through quarter 2. We just closed quarter 3, so we won't be reporting that, James, until November 8th, I think. November 8th, close of business. But you can see quarter 2, we were obviously a combined company, not for the full quarter. We had 2 months plus a week. Made a nice challenging close for our finance guys, that extra week. But we grew 75%. Underlying growth year to date, 8.5%, on the back of a 16% growth last year. So we're pleased with ahead of our target. We said we'd grow kind of north of 5. So good underlying performance. And again, we haven't reported Q3 yet. We picked up $35 million in new business in 2022. I'm sure shareholders are aware of that, and that continues through 2023. Gross profit momentum, you can see that we grew 56.7%. And we've had 8 consecutive quarters of year-over-year growth on gross profit. As I said, and you'll see that in a chart in a minute, gross profit very different between the 2 companies. So our average is going to go down, but we have a clear path to take that north very quickly. And you can see our EBITDA momentum as well continued through quarter 2. And again, we're due to report quarter 3 shortly. I think this is an important chart to share with what kind of our expectations are over the next couple of years. We started, as I said, our EBITDA was $41 million as a legacy standalone DCM business. We picked up $23.6 million through the acquisition. Synergies between 25 and 30 million. And the one thing we did not model in, and we haven't really reported to shareholders, are gross synergies. So we reported hard, I call them hard synergies, so cost synergies, 25 to 30. We see an opportunity for between 5 and 10 million in EBITDA from gross synergies. Essentially, every $10 million in revenue generates $1.4 million in EBITDA at 14% EBITDA. So we do see opportunities for continued growth in the market, possibly even beyond the numbers we have here. So we see a path to 100 million fairly quickly after we deliver those synergies and continue to accelerate growth. Few charts for you to illustrate a couple of points I made earlier. If you look at just before that dotted line there, Q1 2023, you can see that legacy DCM reported a 31.1% margin. You can see the growth curve, right, from 22% back in 2016 up to 31. So really, we really know how to win in this market and how to drive profitable growth. You know, those important high margin profit pools, and how to drive our commercial model and our asset base to win in those areas. You see that in Q2 we dropped to 26.9. That's because obviously the MCC business had considerably lower, that 20% margin. And but we do have a path to get that back up very quickly to 30 to 35. Got an active program there. Okay, but again, just watch that number. You will see that number because of the acquisition be a lower number, but I can tell you that we have great plans to continue to accelerate and essentially apply the DCM playbook to drive that value creation over time. We've also got a proven track record of reducing headcount. The acquired MCC business took our headcount from 910 to 1822. We have a plan to reduce that by 20% within the next 18 to 20. So about 36% reduction in headcount over the last 5 years on our legacy business. And we're just going to apply that playbook, post-acquisition, which is essentially what we're doing now. Which leads me to this chart. You can see that the progress we've made on revenue per associate, again, a key metric for us, up from 225,000 per associate, an improvement of 33% over the last 5 years. We can see a path to 400, and that's with kind of modest growth. So we could actually see a path to 500 if we achieve kind of high single-digit growth. So we see lots of opportunities for productivity improvements over time. And then we've had a proven track record of debt reduction. You can see that our debt post-transaction was 143 million. As of Q2, 114. And I think this next slide shows total debt at 93.6 at the end of Q2. So we're deleveraging very quickly, and we have the ability to deleverage even quicker as we continue to grow. So good opportunities. We've got good kind of free cash flow in this business that we'll use to deleverage super quick. And remember that 93.6 includes the sale of one site. You can see Oshawa up there at 23.1. We had 3 sites that we acquired. Obviously, the other 2 aren't the size of Oshawa, but we still have 2 that we will be transacting shortly, and that obviously will help continue to reduce debt quickly. Another thing we're really proud of, I should have updated this chart for this presentation because we reforest 100% of our paper use. And we've been doing that for the last year and a half. So you can see that up until this was the end of August, we used 79,708,000 pounds of paper in our workflow for clients. And we reforested for every 83 pounds of paper, we put 1 tree in the ground. So we reforested 959,000 trees. We actually just crossed a million trees in September. So we put 1 million trees back in the ground. This is a great program for our clients because our clients can take advantage of this for their ESG efforts. We flow it through to our clients' ESG program. And most of our clients do take credit for it. So closing remarks. Look, we've got a clear 5-year strategic objective. Organic growth in north of 5%. We're certainly on track. EBITDA of 14. We didn't talk a lot about our MarTech solutions. That's a whole separate agenda, but we see big growth opportunities there. That $1 billion you see in the bottom line, a 5% growth would get us to about 700. 8.5% growth would get us to around 800. So if we want to get to $1 billion, that would imply we would buy, roughly 200 million in revenue. May not be one tranche, be some smaller tuck-in opportunities, but we do see a path to $1 billion in the next 5 years, and then, of course, we're going to deleverage very quickly, and you can see, kind of our proven track record over years, and certainly, post-acquisition. Market cap, I won't spend any time on here. It's moving around a little bit. I think our recent share price, not $294, about 176, and insiders, directors, and officers, including myself, about 28%. Our employees, we've got an ESOP program, around 3%. KST is an investor who's been in this business for a long time, about 10%. And we've got the capital raise that we did actually brought in some great institutional investors as well. So got a good mix of shareholders. Great, thank you guys, appreciate it.